One of the biggest drivers for the financial markets, such as foreign exchange, equities, indices, and even commodities, are central banks. Most traders focus on the rate decision itself, and this is completely wrong. The rate decision has already been priced in by traders and investors. Where the real source and the real advantage lies is the forward guidance, and this is how said traders and investors begin pricing in the rate decision for the next meeting. So allow me to break this down very simply for you and explain and show you how central banks work and how we as traders can gain an advantage by paying attention to what they are doing and saying. Before we go too far, we must understand what the goals of a central bank are. Central banks have what we call a dual mandate. This dual mandate takes care of two things, which is price stability, which means keeping inflation under control. Most central banks will have an inflation target of around 2%. Secondly is to maximize employment, meaning less unemployment claims, more job openings, and more people getting hired. The job is to balance these two things. Think of it like a seesaw. If inflation becomes too high, the central bank might lean towards hiking their interest rates. This is done in an attempt to slow down the economy. With higher interest rates, it becomes more expensive to borrow money, and if the labor market or the jobs market begins to collapse, the central bank might look to cut rates, and this is in the attempt to do the opposite. They would be trying to stimulate the economy with lower interest rates. Let's dive a little bit deeper into the complexities of hiking, holding, and cutting. A central bank might hike their rates if inflation is too high or rising too fast, if an economy is overheating with strong growth and a tight labor market, or if they need to cool demand to bring prices down. Raising rates makes it more expensive to borrow money, meaning consumers spend less, businesses invest less, and credit slows down. This can reduce demand, which eventually leads to lower inflation. We can spot inflation with two main things, which is CPI and PCE. These can show if inflation is above target, below target, and how it's trending. We might also see a central bank hike due to strong GDP growth and strong retail sales. Again, these are both indicators of a hot economy, or if the labor market is above capacity. Now, of course, there is no set number for a capacity on the labor market. However, very low unemployment and strong wage growth both lead back into inflation rising with more people spending money. Now, let's just talk about the market reactions from a rate hike. When a central bank hikes their interest rates, that currency then becomes more attractive, and this can influence what we call a carry trade. Think of it this way. If you have a bank account in, let's say, America, and you have a bank account also in Japan, Japan's current interest rate is at 0.5, and the US's interest rate is at 4.25. The interest that you get for holding money in yen in your Japanese bank account is significantly less than what you get for holding your US dollars in a US bank account. Now, of course, you need to think of this on a larger scale, but the principles remain the same. Now, equities and indices markets normally fall on rate hikes because future earnings are more discounted, and for them to expand becomes more expensive if they need to take out loans and borrow credit. And then gold and other non-yielding assets generally fall as real rates begin to rise. So as traders, if you see consistently high inflation coming out of PCE and CPI, along with hawkish central bank comments, you can expect rate hikes to emerge. We'll get into hawkish and dovish comments by central banks later in the video. This is an example of a hiking situation. Inflation is at 4%, unemployment is at 3%, and retail sales are booming. This is just a classic environment for hikes. The Fed will decide to raise rates to prevent runaway inflation, even if it slows down growth gradually. Now, in a situation where the economy is doing the opposite of what we just discussed in a rate hiking situation, a central bank might opt to cut rates. So if the labor market is collapsing and or the economy is in deep trouble, if growth is weak and unemployment is sharply rising, or if we are seeing deflation risks. So when a central bank decides to cut their interest rates, it makes borrowing money much cheaper, meaning businesses can expand, hire, and invest more. Consumers can borrow and spend, and credit flows more freely. So hopefully you can see, if businesses can hire more people, they can invest more money, they can expand more, and if consumers can borrow and spend more, this can stimulate the economy. But what could trigger a rate cut? Well, rising unemployment, as well as weak payrolls, GDP contracting or showing near zero growth, and inflation below target or falling sharply, indicating a deflation. Now, the market impact is exactly the opposite of what we discussed with rate hikes. So currencies can weaken as their attraction decreases, and investors and traders move to higher yielding currencies. Equities and indices can rise as there's more optimism around them being able to expand. Gold can rise as real rates fall and fear can increase around the economy and its stability. So as traders, if you see labor market weakness and deflation risks, you should expect and get ready for a rate cut. Here's another example. Unemployment jumps to 6%, GDP shrinks, and inflation slips below 1%. The central bank is likely to aggressively cut their rates to stimulate growth as much as possible, even if it does mean weakening the currency in the short term. Now, a central bank has one choice left. They can cut, they can hike, or they can hold. A central bank will normally hold their rates when they have a stable economy. A central bank may decide to hold their rates for a few different reasons, such as if the economy is already quite balanced and stable, if they have previously hiked or cut rates and they're waiting for the effects to still kick in, if they have mixed data, for example, inflation might be falling and jobs are softening, or if they don't want to overreact with a change of rates and cause unintended damage. For example, it would be irresponsible for a central bank to cut rates just because of one lowered CPI release. So when a central bank holds their rates, it means there is no change. So it keeps the conditions stable, and it signals what we call as traders a wait and see approach, meaning they are just waiting for more data to come in and then they will assess. So typical triggers that can cause a rate hold are inflation is near target or stable, the labor market is healthy, not cooling and not overheating, or mixed data where neither the inflation or growth data is dominant. So the market impact might be as you assume, which is relatively muted. Markets will focus on the forward guidance to see what they expect to come next. In this case, if the statement is hawkish or dovish, we might see a larger reaction from that statement, with traders and investors pricing in the next decision. For anyone that doesn't know what hawkish and dovish mean, to keep it simple, think of them as the birds that they are, a hawk and a dove. They are animals just like bulls and bears. Hawks fly high, doves fly lower. If you hear something hawkish, the currency is likely to fly higher, and if you hear something dovish, the currency is likely to fly lower. But what you need to know is that holding doesn't mean that the central bank isn't doing anything. A lot of the time, it's about reading the tone and reading between the lines of the statements to see which way the central bank is leaning. It's very rare for a central bank to be completely neutral. Normally, you will see a lean towards hawkish or a lean towards dovish, even if the rate decision was a hold. So here is an example. Inflation is trending down towards 2%, but unemployment is ticking up. The central bank is very likely to hold their rates to see if inflation continues to tick down and unemployment ticking up. Again, they don't want to overreact to a one-off release. So this is how you can start thinking like a central bank. First of all, you need to monitor the pillars and consider all of the major data points. So for inflation, we need to monitor CPI and PCE. These are the main measures that central banks watch to monitor inflation. Secondly is the labor market. You need to watch NFP, which is non-farm payrolls, unemployment rate, jobless claims, wage growth, and JOLTS. This may sound very intimidating. However, you can access this data on every news calendar, and there are some softwares out there that you can use to track the historical data to see the trends. Services like Market AI and the A1 Edge Finder are great tools for this. From this point, you must identify what the most urgent problem is. For example, high inflation and strong jobs is likely to lead to rate hikes. Low inflation and weak jobs is likely to lead to rate cuts. Mixed signals is likely to lead to a rate hold. Let's take the current landscape within the US to give you a real-world example. Inflation is rising in the US, so this would tell us a rate hike might be on the way. However, the labor market is showing major trouble with weak NFP, higher unemployment, weaker JOLTS, and this would tell us that there's a rate cut on the way. So how do we know which one to prioritize? Well, in this case, we can very clearly see that the labor market is collapsing. NFP has been on a downtrend for a long time. Unemployment has just broken out of a sideways range to the upside, and the Fed has been on hold for a significant period of time, as well as pressures by Donald Trump to lower the interest rates. So I have come to the conclusion that the Fed must cut 25 basis points. There is a small possibility of a 50 basis point cut. However, I do not think the Fed can do this, and this is because of the rising inflation. The Fed cannot overcut because inflation is holding it up, but they cannot afford to hold or hike because the labor market is in a detrimental position. And this is where understanding how a central bank can think, how they prioritize, and how you need to critically think can play a massive role in your performance in trading. Now, market reactions are something I get asked about all the time. How will the market react if the Fed cuts 25 basis points? How will the market react if the ECB decides to hold their rates? And this is overlooking the complexities of the markets. Investors and traders have already priced in the rate decision beforehand. So for example, right now the large consensus is the Fed will cut 25 basis points in September. If the Fed goes ahead and does cut 25 basis points, this isn't a surprise. Everyone has expected it, and large players have already placed positions betting that this will be the case. So the reaction from that rate decision, if it does come out at 25 basis points, is likely to be very, very muted. However, if the central bank decides to surprise us, whether they hold rates again, or they cut 50 basis points, or even if they decided to hike rates, this is when we would see a large reaction, because investors and traders priced in 25 basis point cuts and they were wrong. So they'll be closing positions, taking profits, taking losses, and repositioning straight away. However, this is quite rare. Normally with rate decisions, we are quite accurate. And when I say we, I don't necessarily mean me, I mean the markets are very accurate at pricing in the correct one. A lot of the movement comes from what we call forward guidance. Forward guidance comes from the press conference that we have half an hour after the rate decision. And this is when, in this case, Fed Chair Jay Powell will talk about his reasoning for the rate decision, and he will talk about his views on the economy as a whole, such as growth, the jobs market or the labor market, inflation, and anything else that's going on, such as tariffs. Press will also be there to ask questions, and sometimes the answers to these questions can answer what we need to start pricing in, what we expect the next rate decision to be. Let me give you an example. If Powell says he is concerned about inflation, as inflation is rising and rising further and further away from his 2% target, this could indicate he may want to hike rates in the future if inflation does continue to climb up. So we can pay attention to inflation data, and if it does start to climb up, we can start preparing for that rate hike. However, if inflation then goes ahead and falls lower, we can prepare for a rate hold, or maybe a rate cut, depending on the larger landscape. So on the screen, you will see a cheat sheet. Feel free to copy this or screenshot it if you want. High inflation and strong jobs generally lead to hikes, the currency will strengthen, and equities will weaken. Higher inflation and weak jobs can lead to a small cut or a hold, giving mixed or volatile reactions to currencies. Equities can also have a volatile reaction. Low inflation and weak jobs can likely lead to a cut, weakening currencies and causing equities to rally. Low inflation and strong jobs can lead to a hold or a small hike. This can mildly boost currencies, and equities might be stable or have a very small dip. And finally, let's talk about forward guidance. Central banks will rarely surprise the markets with sudden decisions. Instead, they will signal their intentions ahead of time through forward guidance. This allows traders and investors to set their expectations in the markets ahead of the next decision. The challenge central banks have is they can't come out and say we will cut in the next meeting, we will hold in the next meeting, or we will hike in the next meeting. What they say is very carefully crafted. It's often vague and cautious, so it's our job to read between the lines and interpret what they say. Our goal is to decide, are they hawkish, neutral, or dovish? So we first of all need to understand what they care about at this moment in time. Before trying to overanalyze what they are saying, we need to know what the issue is. What is their priority? Is it inflation, employment, or financial stability? Understanding this context can shape their tone. If inflation is high, we can go into it expecting hawkish comments. If inflation is low or jobs are collapsing, we can expect a more dovish tone. If a central bank is hawkish, you may hear things such as further hikes may be needed, inflation remains unacceptably high, policy will stay restrictive for some time, and this means they are worried about inflation and leaning towards tightening. In a situation where they may be dovish, you will hear things such as, we are prepared to act to support growth. Labor market conditions are weakening. We will provide accommodation as needed. And this means they are worried about slowing growth and leaning towards easing. If a central bank is completely neutral, you may hear things such as, we are monitoring incoming data closely. Policy remains appropriate at this time. Future moves depend on data. And this shows a balanced stance with no clear bias. Now, it may not be this clear in every meeting by every central bank, but as you listen more, and you pay attention, and you become more knowledgeable in this area, you will start to be able to understand more vague wording. Here's a little tip. If a central bank is hawkish, their words will usually focus on inflation risk and overheating, while dovish words focus on growth risk and unemployment. Now, markets don't just react to the meeting itself. They react to changes in tone and changes in wording, so you can compare it to the previous statement. For example, in the last meeting, the central bank may have said something such as, we may need further hikes. In this meeting, they may have said something such as, we will carefully monitor incoming same data. Even though both sound cautious, the shift to show less urgency in this meeting has a little bit of a dovish undertone. You should always compare the previous statement to the newest statement. This can give you a completely new context. Another way to easily gauge a central bank's stance is by using a free tool called the CME FedWatch tool. And on this site, you can easily see what the markets are expecting for the next meeting. And this will change as more data is released, but it does help guide us. Ladies and gentlemen, this concludes the video on central banks. You should now have the core knowledge base to understand central banks' priorities, goals, targets, and how you can understand what's happening. So next time you see someone on social media say the Fed cut 25 basis points, why didn't Nasdaq move down or move up? You know exactly why, because you now have a big advantage over the massive amount of retail traders who are stuck drawing lines and boxes without any context of what's moving markets. Please like and subscribe, it does help me out a lot and I do really appreciate it. If you would like to join my Discord and learn with me and take the same trades that I take on a daily basis, you can click the link in the description. It's free for the first week. Enjoy the rest of your day, your weekend, your week, whenever you're watching this. Stay safe and don't get margin called.